And now it's time to discuss the last part in this important section on forecasting. We're going to touch base on a really brief overview on how exactly you should forecast out the balance sheet. Like we spoke about earlier, the balance sheet follows the base framework, which means you take the beginning balance, add any additions to that amount, subtract out any subtractions, and then you'll get your ending balance. So for example, your accounts receivable. The beginning balance is going to be equal to the prior period's ending balance. You'll add any amounts that you invoice to customers, you'll subtract any amounts that you received from customers, and then you'll get your ending balance. The most common balance sheet accounts that you'll forecast are inventory, deferred revenue, accounts receivable, accounts payable, capital expenditures, and debt. Remember, a key difference between the balance sheet and profit and loss is the fact that all of the balances shown on the balance sheet are cumulative. So that differs in the way we're going to project information. By default, I like to set all of my balance sheet accounts equal to just the prior period, which will allow me to have a zero impact on cash flows. Remember, if the amount has a balance in 1 month and drops down to zero in the next month, that'll have a cash impact. Also recall that certain accounts need to be tied directly to the profit and loss. So for example, accumulated depreciation and accumulated amortization needs to pull directly from the profit and loss. The same for retained earnings and net income on the balance sheet. Also, your cash will need to pull from your statement of cash flows, but every other account can follow this base formula. As you get more into depth in balance sheet forecasting, you'll want to set up what's known as a waterfall, which will allow you to amortize an amount each and every single month from the initial starting balance. In this example over here, you can see that we have a $90,000 booking, and we're amortizing, because it's a 3-month amortization period, each month $30,000. All right, and that concludes the final section on projections. Now, once again, that was just a really brief overview, and there's so much more that I look forward to covering with you in future courses on each of these areas. Now let's go over our final interactive session to build our robust financial model with actuals as well as projections.